It's kind of good that you're starting with me, I guess, because I'm sort of a hybrid, right? Practitioner, academic, both in my own career, but also representing the CFA Institute. So I'll represent, as best I can, the entire CFA Institute's position, and then we'll talk a little bit more about the journal. Quick question, any CFA charter holders in the room?
Show hands. CFAs?
Okay. Candidates? No. Oh, there we go. Well done. Okay. So, as many of you will know, we are an accrediting body. We're a group of membership. We're a membership body, and we accredit new investment professionals. So, like universities, we are concerned about what it is that investment professionals know. What's the minimum required? What ought they to know? And so from our curriculum development point of view, we've certainly seen ESG come into that. A little late, I feel, but we've come to the party, and it's now part of our core curriculum for CFA charter holders. We have ongoing education for our members, so members in good standing, we're encouraging them to do continuing education. Universities, do you do the same? And we put out constant material to encourage our membership, our professional investing membership, to keep up to date with developments in this area. So I don't know about you, but when I got my charter in 2003, I don't think I'd ever used the word stakeholder before. So a lot has happened since then, and it's important that people keep skilling up, that professionals keep skilling up. We have an advocacy arm, and the advocacy arm, as Ben mentioned, is involved in stakeholder engagement, particularly with legislators. So I think of a couple off the top of my head, the accounting standards, looking for good reporting, et cetera, et cetera. So they'd be engaged on that level. And then I'm on the thought leadership end, which is our research arm, running a scientific journal, academic journal, looking to impact on investment practice. So our aims and scope are very much aligned with this conference in terms of really trying to get thought leadership, good research, but that also has an impact on investment practice and leading the institutions from there.
Thank you. Over to Julie.
Okay, so good morning, everybody. As Rob mentioned, over at UBS on Monday, we held a really, I think, pretty amazing, I think it's fair to describe it, ESG and Sustainability Symposium. Many good things start out in academic networks, and actually I have to put responsibility for the idea exactly where it lies, which is actually with GRASFI. A year ago, I read about their conference, their inaugural conference in the Financial Times. I thought the network looked fabulous. And so actually my colleague Vicky, who's sitting just over there in the audience, went to see what it was actually like on the ground and took lots of notes, and we thought it was really excellent. So why were we so interested in GRASFI? The key question of our conference on Monday was really the sort of $64 billion question. On the one hand, when you look out at the science, you look at the IPCC Special Report number 15, the 1.5 degrees report, or you look at the Global Biodiversity Assessment, all you see is terrible numbers going in the wrong direction. CO2 emissions not falling, CO2 concentrations going to a new high every year on Mauna Loa, water stress, air pollution, potential risk to food chains. Need I go on? You've seen the litany of bad news in the press. And of course, every time now there's a heat event or a flood or a drought, that goes up there as well. The Cape Town drought was written about in our research actually last year. And on the other hand, as Robert just mentioned, there's a huge amount of interest in ESG, impact investing, sustainable investing, ESG integration, and so on and so on. So we just said, well, look, why is there such a gap? We know that our industry is really focusing on this, and it's just becoming more and more dominant. The conference that we held on Monday, our chairman, the chairman of UBS, teleconferencing live because he couldn't fly over. Of course, I thought that was great from a carbon emission perspective. We also had our global group head of research as one of the keynote speakers. Dr. Maria Zuber, who's a very prominent scientist from MIT, who has an asteroid named after her, came in as our keynote. And we had representation from a really wide range of different stakeholders. We also held an academic panel, so we borrowed a few people from this conference to come in and basically debate one of our several questions on the day. And I would say in a conference like that, obviously you don't get the answer to a question like, so how can we close this gap? But I think what we did do was to suggest that we need to do a lot of tire kicking, as it were, of accepted models. One of the key things about our approach at UBS, I've been working at UBS for over a quarter of a century, and I've been, sounds horrific, doesn't it? It's even longer since I did my CFA. We've been working on ESG and sustainability. It will be actually 15 years in April this year coming. So you know the answer to that question, the first question isn't going to be a quick thing, but on the other hand, what we do have, I work in equity research in a team of really excellent analysts. And in ESG, we think mainstream analysts know a lot more about ESG and sustainable investing and environmental risk and so on. They know much more about it than we do. And the reason is we're in the ESG team, we're the generalists, but they're the people who really understand what companies have to do to compete and survive in their industries. They know what they have to do to stay ahead of their peers. And as I very often say to people, you know, a company that wrecks the environment is useless, a company that goes bankrupt is useless. What you really need is that balance in the middle. They're the people who can help us to understand that. One of the things we emphasize a great deal in research is ambiguity. And we try and apply systems thinking whenever we can. And one of my favorite pieces of research was a short note from the autos team in the context of electric vehicles, driverless cars, clean energy, with a view to making mobility greener. And the panel of MIT professors said, well, we don't know if green mobility will be environmental heaven or environmental hell. Environmental heaven would be green energy, fewer CO2 emissions, frugal use of transport, frugal use of resources, sharing rides, etc., etc. But the polar opposite, of course, is people love technology, they love replacing their gadgets, they're in love with their cars, maybe they'll do millions more journeys. Even if you have lower CO2 emissions from car transport, you still get a very consumption-driven, resource-intensive system. And they were unable to predict which it would be. And I leave that question with you for the discussion.
Thank you, Julie. Nick.
Well, thanks very much, and it's great to be here at the second conference. We're talking about the future, so I'd like you to imagine and think ahead. I'd like you to imagine that you're sitting with 2,000 other people at the 12th GRASFI conference in 2029. We're 1 year before the pivotal date of 2030, when we know we need to halve global greenhouse gas emissions if we're going to be on track for 1.5C. We need to halve global poverty. We need to have universal access to education and housing and water, and we need to have equal access between men and women to all those good things. So I want you to think about what we, all of us, individually, need to do in those 10 years, particularly in the application of best practice research and learning. Now, clearly, much has happened, which is great in our world, as we've heard in terms of policy, in terms of practice, and also in terms of research and the world of academia. But I think we need to have a couple of reality checks. The latest International Energy Agency report on energy flows said that there was little sign of the capital reallocation that's needed to meet the goals of the Paris Agreement. So despite all the busyness that's happening, we're not getting the capital reallocation. Duncan Austin, who many of you may know, a very smart investor in the world, has actually come up with this new phrase called the green wish. We're not actually threatened by greenwashing. We're threatened perhaps by ourselves of actually wish fulfillment about actually how good and how strong the shift towards sustainable finance is. So maybe I'd like to suggest to you sort of seven themes we might want to think about in terms of getting from here to 2029. We don't have a $64 billion question, Julie, in fact. We have a $379 trillion question. We need to think about the entire financial system. I think there's some very, very good work. We were delighted as part of the INSPIRE program to work with the NGFS team, the central bankers yesterday. But I think how the actual financial system operates so that actually it delivers sustainable development is very important. Between now and 2029, there'll probably be 2 financial crises. We're going to have to think very, very carefully about the metabolism of the financial system. Second is we need to rethink time and space. I think we're getting much better in thinking about short-termism, long-termism, still a long way to go. One of the things I think influencing our work is really thinking about the spatial dimensions of finance and so on. This is where things matter, particularly in terms of nature, in terms of biodiversity, impacts of climate change, but also things that really matter for people. Place. And actually finance is very, very bad in actually serving the needs of place. And that's particularly a big theme around the just transition. We also need to be a bit honest about ESG, that this is often implemented in silos, that we have an environmental track, we have a social track, we have a governance track, and there the three shall meet. I think this sort of misreads the real world. As I mentioned, when we're thinking about any form of the ecological transition, this has huge socioeconomic implications in terms of health, in terms of employment, in terms of gender. We've got to actually break down those silos. Then, of course, finance has a purpose. It is actually, professionals have a purpose. It's there to actually, finance is there to serve society, to serve households, enterprises, businesses, and so on. And we need to be much better connected to the so-called real economy. And maybe that means that the models we use need to be much more realistic. Too often we have hypotheses and assumptions which really do not reflect actually how the world really operates. Then we need to think about innovation. And clearly there is huge innovation going on, technological innovation, there's fintech, and I get emails on LinkedIn every day about some new fintech startup with some new blockchain innovation and all the rest of it. So we are going to think about what we need to do on sustainable finance, the analysis we need to do, the teaching we need to do, is actually really thinking about this, both in terms of the opportunity, but also the huge downside implications of rapid technological change. Innovation in ownership models, that particularly in terms of impact investing, but actually sort of non-stock market, non-classic models of the Anglo-Saxon world, let's say, and maybe governance models. All of this means we need to be much more global. We cannot assume that best ideas, best practice will come out of the North Atlantic. My friends in India talk about 2000, 2007, 2008 as the North Atlantic financial crisis, which it was. It was not a global financial crisis. So it's great to see the leadership that's been taken by China, Chinese policymakers, but also Chinese academics. Without the intervention of China, we would not have the global green finance debate. So what are the real issues that come out of Africa, out of Latin America, out of India? This is a real priority for our research community. So then sort of maybe some thoughts about how we do this. It was very good, Ben, in your introduction about the sort of the multidisciplinary approach that GRASFI is taking, really, really key. One thing that came out of our meeting yesterday between researchers and central bankers was actually about sort of joint research, and I think that's a very interesting area. Obviously, academics need to be objective from the sort of the actors that they're studying, real potential for sort of joint interactive research. And then I think also we need to think about what this means to be professionals, whether professionals in the investment world or professionals in the academic world, and the standards and the ethics in terms of our views on humans and environment. So I would ask you again to think ahead to 2029, and by then also many of you in the room will also have won Nobel Prizes for sustainable finance. Thank you.
Thank you, Nick. Professor Bob Eccles.
So I'm the token academic, Rob, on this panel. Let me start by saying I think it's important to have aspirations that go beyond your daily work, like Nobel Prizes. Well, I'm never going to get one of those. I've got a hero named Eddie Hall. Look him up, Eddie Hall, deadlifter. But I'm not likely to achieve what Eddie Hall has achieved. But you've given me an idea. Julie, I'm going to get an asteroid named after me. I don't know how to do that. I went to MIT. I know folks there. So let me see what I can do about this asteroid naming thing. Sounds pretty intriguing. So there's 4 things on my mind. Rob said I could only talk about 3. So I'll talk about the first one in 10 seconds. It's called the Statement of Purpose. Professor Kay in his opening keynote speech and Professor Colin Mayer in his closing one will be speaking on something that's directly related to that. So Colin will probably talk about that work we're doing together. The 3 things that I will talk about are standards for non-financial information and exclusion versus engagement in sustainable finance, and private equity. Those are 3 areas along with statement of purpose that I'm working on now. And I think all of these lend themselves to research from the academic community, as Ben was talking about in his opening remarks. In terms of standards for non-financial information, to kind of cut to the chase, I think we need to have standards for ESG non-financial information, just like we do for accounting, for financial information. Standards didn't always exist. They're a social construct. They were created in the United States by the SEC. We take them for granted. They've made the capital markets as big and liquid as they are. Big debate now about should we have standards for non-financial information. There's a whole alphabet soup of acronyms. There's GRI and SASB and CDP and DCFD and IRC, and some are standard setters and some are framework setters. It's confusing to everybody. I think we need to cut to the chase and get to standards. Richard Barker and I wrote a green paper on this where we kind of posed, here's the good points, the bad points for market solutions, regulatory solutions. I don't think we're going to get there as a market solution. Market solutions didn't get us accounting standards. I think we need a path to get to a regulatory solution. Richard and I have written a short little white paper on that. So I think in terms of areas for academic research, one would be how do standards come about? How are standards created? They're never technically perfect. As I said, they're social constructs. Is it always been from regulation? Are there industry groups like you have with internet standards? So what is the combination of market and regulatory forces that lead to a set of standards that have social legitimacy, that are basically believed in and used by everybody? Then you need market forces to get to a certain critical mass. Then the regulators get the courage to step in, and most of them seem to be supine in a lot of ways, particularly the SEC and the United States. So how do you get to standards and basically reporting requirements that everybody's going to whine about, as in say, doesn't exactly apply to them like they still do with accounting standards, so they have non-GAAP measures. But you need to have that same quality of information, same quality of assurance, so that you've got a level playing field between the financial and the non-financial. And I think that's one area of research on this topic. I think a second, and there's some papers on this at this conference, I'm pleased to say, is what are the benefits of having standards and reporting requirements? You know, do they change behavior? Do they lead to better decisions on the part of companies, part of investors? So this whole domain, how do we get to standards and what are the benefits of standards? I think that's an important area for research. Second area that I'm looking into, and this is newer, is this question of exclusion versus engagement in sustainable investing. Judith and I, with a colleague, Stephanie Mui, who did her DPhil here, are working on a paper she'll presenting this from the company side, the asset owner-asset manager relationship with some people from Hermes. We're looking into this. It's a complicated question, and it's a very emotional question, as I've learned, in particular industries. I wouldn't claim to have the right answer in any particular industry. I know there's a paper on divestment in oil and gas. I think there's good arguments that can be made for both exclusion or divestment and engagement. What I'm searching for, and haven't found, this could be an area for research, is what is the theory of change for exclusion alone? And if there is a theory of exchange for you can get enough exclusion for enough parts of the capital market that is going to put whatever the pressure is that you want to put on the company or the particular sector of interest that's going to change their behavior in ways that you want. If exclusion alone can do it, then that's good to know. If it's insufficient, if exclusion is important for signaling, for putting pressure on industries, for putting pressure on companies, but it alone will not be enough, that you need to have engagement by the shareholders who still own those stocks, who then pay attention to the negative externalities that are being created by these companies, then I think it's important to know. And it's probably no simple answer. It could depend upon the size of the industry, the profitability of the industry, what the balance sheet of the industry looks like, how big it is in terms of market cap. Some industries that there's a lot of exclusion are small, some are big, and it's interesting because it seems to me, anecdotally, that there are two competing trends going on. One is that the degree of negative screening or exclusion is going up, particularly in Europe, and you see that in certain industries. And at the same time, you're starting to see some pushback from other groups, more kind of the so-called maybe mainstream, saying, look, we kind of get what you're trying to do, but we're not sure that that's going to solve the problem. Sorry, excluding for values reasons, perfectly legitimate. People have their own values and they should, invest their money as they see fit according to that. Or value reasons because you think either the industry's going down the tank or you think that, by engagement, by exclusion, you can do something both to deal with the externalities and to deal with the economics. Third thing, again, fairly new, is private equity. A couple years ago, I wrote a little piece in Forbes.com because I'm too old and I'm just not sufficiently trained anymore, Rob, to get published in academic journals, so I settle for what I can do.
That's why you're on the panel, Bob.
That's why, the token, not a real professor. I have to publish in Harvard Business Review and things like that. It's a good brand, but everybody laughs at it. And it's still hard to get into. But Forbes.com, I have my own column. I can do whatever the hell I want. It's great. So I wrote a little piece about how I thought private equity could lead the way, in engagement in ESG. I mean, think about it. Here's these GPs. They basically own these portfolio companies. They can more or less tell them what to do. They could say, look, we've seen the value proposition for ESG, as the other panels have been talking about in public equities. Companies are a little smaller. No reason the logic should be any different. Let's use SASB, whatever, give us the 4 or 5 material things. We're going to track that. It's going to be good for the exit strategy. We're going to engage with you. The deal guy is going to, not much is going on at all, okay? Did a little project, talked about this summit, a conference Ben had a couple months ago, looking into getting data from PE companies. And the LPs basically said, it's a great idea, but we're not going to lead the way on this because guess why? They'll cut our allocation. If we make too much noise, they'll cut our allocation. I thought, bloody hell, what a great business to be in when your customers are afraid of you. You're a big PE GP out there, and the big LPs, all the usual suspects, say, I don't want to be kind of in the lead around asking for both that the GP get it and that I get it if I want access to data on the ESG performance of portfolio companies. I read a McKinsey report that came out about a month ago. There's twice as much net assets in private equity than the value of global equities. So you've got this huge asset class of private equity that's basically kind of a dark box, right? There's very little visibility into what's going on. And when you add up all those assets and you think about the system level things that Nick was talking about, I think it's really important to know what's going on. So what is it that we need to do to kind of drive visibility into the portfolios of the GPs in the private equity industry? And a very important piece of academic research that would contribute a lot to that, and it comes up every time I talk to a big GP, is, where is the academic research that shows a positive relationship between ESG and financial performance? If there's some, I don't know about them. If you know some, please let me know. There's lots of work, as we know about, that's being done, an increasing body of work in public equities. You can make the argument, as I said, don't know why the logic should be any different. But if we could develop some research showing that there is a positive relationship between ESG performance in private companies and maybe enhanced by engagement, I think that would be enormously important, because then I see ways that you could scale that pretty quickly by going to a relatively small number of LPs and a small number of GPs and launch it from there.
Richard Levitch from NYU. I was intrigued by the distinction between exclusion and engagement. I'm wondering if you view them as either-or propositions. It might seem if you get a lot of divestment, then that motivates activist shareholders to come in and do something, and to trim the divestment. One leads the other, but are they in opposition?
Bob.
Not necessarily. Legal in general has got a pretty sophisticated approach to this, if you're familiar with their climate impact pledge, where, they basically have identified 84 companies, 80 companies, something like that, and they engage with them and they give them, a couple of tries to get better, and if they don't, then they kind of ding them. They vote against the chair and whatever, and then they list who they are, and in the last time they listed 8. What I have found is that it tends to be binary, but not only is it kind of binary as choices, once people have made the decision to exclude, they won't even talk about it. They won't even talk about it, okay? I tried to organize a panel for a conference in Berkeley, in a particularly controversial sector, tobacco. And I couldn't get a fund that has excluded tobacco to even appear on a panel to talk about why they've done it, okay? And I think when you run into a situation where people have made the decision to exclude, and they're not even willing to engage with the people who want to engage, then it's kind of like stalemate. And I don't know where you go with it.
Anyone else would like to respond to
Yeah,
this?
I have a different example which goes back some years. So we'd been doing ESG and sustainability at UBS for perhaps, 3 or 4 years. And we were traveling to Holland, actually to Amsterdam, to do a seminar with clients about exclusion. So this was an instance where people were very willing to talk about it in the public domain. And on we were going to do this seminar on a Monday. And the preceding evening, there was a TV program in Holland, which I suspect you may remember.
The clusterbomb feeling.
You would know exactly where I'm going, yes. There was a TV program naming and shaming pension fund holders of controversial weapons. So we innocently arrived on Monday morning, not knowing about this, but basically with our discussion of exclusion. And everybody wanted to talk about exclusion, engagement, controversial weapons. But I think to your question, that's a combination of exclusion and engagement. So I think the things work very much together. And maybe sometimes exclusion is the thing that sort of tips the beginning of the discussion. But then the momentum behind that topic by the time we arrived in Holland was absolutely phenomenal. So it's kind of an example on going the other direction. Yeah.
And it's a good example.
And it's in Holland, and you were in the States, so maybe it's geographical as well. Yeah.
Nick?
I mean, I think it's interesting to, let's say, if we take the climate change issue, to actually follow it down the chain, because you have actually very interesting examples now. For example, Dong Energy, Danish oil and gas company, which is now Ørsted, effectively transitioned to a renewable energy company. But what it did was divest. It actually sold off through sales of its assets, its coal and its oil and gas assets to other people. And I think one of the challenges that's going to be is not just sort of whether you sell off, whether you're an investor or whether you're a corporate, but actually how you close down certain assets. So it's not just sort of getting them out of your portfolio, but certain things are going to need to be closed down, and obviously closed down potentially with very clear attention to haircuts for investors. I mean, let's look at the case of Eskom in the moment in South Africa, a sort of large utility in South Africa, huge financial problems, huge sovereign risk problems. How are we going to wind down those high carbon assets? So it's not just a selling issue.
Well, and a lot of what they're doing is they're selling them to private equity. There's a German utility that basically took all of its coal assets, sold it to the private equity fund, and their carbon rating went up, and it's like, okay, now these assets are over here in a black box.
Zero transparency.
Yeah, no transparency.
That's right.
Okay, so you tend to talk about this topic from the perspective of the investor or the company, but don't we forget someone, which is the end client, the beneficiary, or let's say the consumers, because consumers can also boycott an industry or they can shy away from an industry. How in your practical life do you actually try to know what they want? How do you actually investigate that? I'm just interested in that. I asked the same question at the UBS conference, and then it stayed quiet for, I think, 20 seconds, Julie? Nobody knew what to say, because the end clients, the pension fund participants, what do they actually want? Any clue on what's happening there? On the practical side?
Not a clue, but a frustration. So actually, one of the things, I think, particularly we've talked a lot about disclosure, and I think one of the things that's very interesting and has been brought in partly by the TCFD, is now that we're getting reciprocal reporting. It's not just corporates to investors and banks, but actually investors are reporting. Investors are investment institutions, putting a lot of effort into reporting about their ESG process, their impact performance, and so on. How much of this is actually getting to the end investor? I mean, I know many of the funds I invest in are doing great stuff. I never get it. And it can't be just regulation. I think
they never ask you, I guess.
Well, I ask for it, but I never get it. So there must be something with all this fantastic digitization of how do we get all the work that is being done by the intermediaries, the investment managers, to the end saver, whether individual saver, beneficiary, and so on. But and then, so your question was, how do those people whose money it is, how do they influence the policies and practices of their funds? Which obviously there is some progress. But that's still by exception, I would say.
Anyone else? No?
Yes, I think I'd like to mention education here. I know this is a subject dear to your heart. Sam Hartzmark's paper was actually very interesting. Sam is a colleague of the GRASFI team. And last year, he basically talked about an event study in which he looked at the fact that Morningstar started rating funds for sustainability, high and low, and the event study observed that money went into funds that were highly rated for sustainability and out of funds that were low rated for sustainability with no movement in the middle. But the interesting point for your question is the expectation of investors in those funds, according to the survey work in that report, was that people were expecting higher returns and lower risk at the same time. If you've been in finance for any length of time, you know that's impossible, or it's unlikely. I mean, if you do find something like that, then grab hold of it because it's pretty unique. I think, therefore, more education on the basics of how finance works would be needed so that the end clients can basically have more of an understanding of what's going on.
But that is an interesting observation. I have to come in here. Because you essentially tell some of these clients don't understand the link between return and risk. But if you go to the average report of any active manager, you only see return, you don't even see risk.
I agree. Yes.
So how can they know? They're not educated. And it brings me to the CFA. So, and you wrote a report on that, Julie, I read, in 2006, something for the CFA. Did I understand that correctly?
Yes, I did.
Already then. But so what is in the education of analysts that is going to change this? Can you give me some concrete examples, Heidi, on what does the curriculum look like?
I always hold education very lightly because there's coming from where I do, South Africa, there's always this notion of education is our condescending to somebody else to tell them you don't really understand what we're selling you here. And I think it's perfectly reasonable for clients to expect more risk, more return for less risk. That's what they want, right? It's not education that's going to change that desire. What I like about the way the CFA is generally set out, and in this case it was something of a leader, was to actually have principles by which you could weigh your decisions. So there's a principle, for example, that says every professional or CFA charter holder is expected to take all reasonable material and information into account when making an investment decision, the objectivity of investment decisions. And so that hasn't had to change with more knowledge of ESG. It's simply saying if something is material, you best know about it. And not knowing about it is a cause for someone to hold you to account. And to say you should be dropped from your charter or dropped from your profession because you didn't take into account material information. So the principle of objectivity, the principle of it being on you to know what needs to be known.
Coming back to Sir Rob's comment, so the relationship between risk and return is a fundamental thing that needs to be completely understood. So generally speaking, if the risks are higher, you would expect the return to be higher to compensate you for the risk. That's the sort of basic idea. But one thing I really do notice is human beings in general, and I'm not just talking about, investor clients or investors, do not like talking about risk. They would far rather talk about the upside. People like to be optimistic, but they don't like to talk about the downside. I just think it's human.
Of course.
And that's something which I think we need to try and push back against. The other thing people find difficult is uncertainty. So, for example, something can be material, but it can have a 0 probability of happening in the next 5 years, which means in your average model it's worth 0. How do you overcome that kind of problem? You need a narrative that can incorporate uncertainty and risk more openly than currently, I think.
Panel, we got some questions at the back here. Is it okay if I interrupt? Yeah, you keep on thinking about the project you're going to do, because that's the last question I'm going to ask you in this session. And Bob, you don't have to answer, you've already got one. So if you're going to do a PhD project, what would it be?
I've often been quite curious how does our thinking, or what the models, especially the CFA models, how do you incorporate the fact that a very huge percentage of stock trading is by computers. Writing is by algorithms and is not a careful analyst looking at a particular stock and reading about their ESG portfolio. I mean, presumably the ESG must get into the numbers somewhere.
Yeah.
But is this part of the gap?
There's quite a lot of really interesting research in algorithmic trading, and particularly the research I'm interested in is the morality of algorithmic trading. Maureen O'Hara is on our advisory panel. She does some really good stuff on that if you want to look that up. My understanding is that trading is more of the execution than the analysis, to be fair, and so there's an efficiency in the algorithmic and the machines trading for us. So I'm not sure that I have a concrete answer for you that you're going to like, but if it's helpful to think of the separation between execution and analysis, maybe that would help. I mean, a related question is too, robo-advising. Well, you know, what's our view on that? Machines giving advice to investment professionals. I mean, investors, should I say.
It's quite ironic. Maybe at some point we have the good culture in the financial institutions and then there are only computers left doing something. Well,
Yeah.
But of course that ties into the ownership story.
Yeah.
So algorithmic trading, computer trading, Bob, I think you'd agree, it tends to be predicated on very short holding periods.
Yeah.
So the relationship between those shareholders and the company is completely different. I mean, I'd say it's not a question of
There's no relationship.
ownership.
Yeah,
There's no
it's an
relationship.
artificial
Yeah.
relationship.
So,
that,
Nick?
I mean, we may know the film Blade Runner, and the book behind that is Do Robots Dream of Electric Sheep? And I suppose, do robo-advisors dream of sustainable finance? We know that code is law, and we know there are many examples now of digital systems actually replicating or enhancing bias, gender bias, and other things. So unless we hardwire explicitly, deliberately, environmental, social, governance factors, both in terms of ethics and materiality, we'll have serious problems.
I named my Tesla Blade Runner 2047. You can name your car. If you haven't seen Blade Runner 2047, check out the sequel.
So one of the issues with algorithmic trading, for example, is that it's perfectly legal to boost a price in a particular direction. So the question comes in between morality and legislation, right? And you're ultimately giving your robot instructions. So who's responsible for what the robot does?
Yeah. Do robots have to pass the CFA?
They do not.
Oh,
We
right.
do not have robot certification, but it has been discussed.
do you think they could?
If you allow me, we go to the room again. So we have a question at the back. Please introduce yourself. And then we go here to Paul.
Hi, Ulf Erlandsson. I'm from a small hedge fund startup, DN Green Credit. First, one remark with regards to the CFA curriculum and so on. The CFA UK is introducing a course on ESG in London. I actually wrote the chapter on portfolio construction, and that's where I want to prop a little thing. That there's lots of things in finance and in economics that you can actually use and just apply ESG on and get some interesting conclusions, such as modern portfolio theory in the ESG context. I think that's a very fruitful area to actually research. Also, second point, I'm from the fixed income space. Bond markets are much bigger. Bonds are extremely interesting. I just ask anyone who's thinking about writing a thesis, go into fixed income. It's much more fun than equities.
But also realize that there's already a lot written on fixed income and ESG that the practitioners don't know of. So that's why we exist, so that we can translate that knowledge to you practitioners in this room. That exactly shows what you say. So I come back to you on that. At the dance party. Paul.
Yes, so I first have an observation on the Hartzmark study that they show that investors expect higher returns. That's not a generalized finding, so there are actually many studies that show exactly the opposite. Responsible investors expect lower returns on the financial investments. That has to do with the particular sample that Sam Hartzmark used. And the interesting thing is that a lot of investors are fine with having these lower financial returns. And what I see a lot in the industry right now is there a whole lot of focus on showing that there is higher returns for sustainable investments, which for me gets the picture completely wrong, because if we have investors who just go for the higher returns, we don't need the sustainable investors. Any hedge fund does it, so we don't create any new money streams towards the places where the money is actually needed by the social responsible investors. So how can we now, and there I'm very curious about your opinion all, how can we get money to the places where it's really needed and show also the impact? Because right now I don't see either it's ESG or impact investments, but I don't see any good reports really showing the impact of what happens with the money.
So I think you're confounding two things, ESG and impact. I mean, the research that's been done basically shows that, good ESG performance at a company level is correlated. I mean, there's always the causation problem with, financial performance. Impact is different, right? Impact isn't something that comes from a company's operations. That's an externality, a positive or negative externality that's being created by what the company is doing, less so with its operations and its products and services. So all this talk about impact, and kind of supporting the SDGs, I think you're right. You don't see major capital going to that because I don't think it's been clear, at least for public companies, given their business models, where those opportunities are. So I think you need to distinguish very clearly between ESG and impact. They're different things.
Although I'd like to combine those two questions a little bit and say that looking at the credit sector is probably a better place to look, right? Infrastructure, green bonds, etc., in terms of actually being able to imagine the direct relationship between capital deployment and something being impactfully done in a community.
Yeah, so first of all, I don't think I confused the two, because if we do ESG, the ultimate goal is to create an impact. Or it's just regular financial investment, I make some money by doing some screens. But I think the goal is, you were talking about that before, that in 2030, we get the emissions down. So then we want to know what is actually the impact that we are creating. And if that is not with ESG, then we are fooling ourselves by saying, we do ESG and by that we improve the world. Maybe we shouldn't do that at all, but we should rather shift the money to something that does have an impact. And there I'm curious to see how are we going to reach that? What are the views that you have? How we really get the money to the places where we do make an impact?
There's an analogy that I'm always reminded of. Maya Statman, he was a behaviorist, I guess, in investments. And he always told a good story, but he used to like to say that when you talk to a Jew about saving money, you don't recommend that he buys pork because it's cheaper and that he gives the money to the rabbi afterwards. And that analogy was exactly the way we treat ESG customers, right? Yes, you'll make more return, or don't worry, you'll make less return, but you'll have ESG. That's not the point. That's not what they want. And that was Maya Statman's point, is talk to the client. Find out what the client wants. A Jew does not want pork, so stop talking about the price of pork, all right? And an ESG or an impact investor wants impact. Start talking about what the investor actually wants.
Okay, now I'm going to take a slightly more market-focused perspective on that, because I love looking at what actually happens in markets. So if you think back to 2006-07, generally speaking, if you talk to people about alternative energy, they thought you were completely mad. It can't happen because energy innovation doesn't get paid for. It's not profitable. So, but clearly we needed that because of the potential impact in terms of the potential to reduce CO2 emissions. In stepped the German regulator and subsidized. We now have an alternative energy market, as described in UBS research by our mainstream utilities analysts, that's working under the forces of economics, right? So it's become a real market. So that's great. Connect that to the mobility story I was talking about before. So we now have all these developments in batteries and powertrain and what have you. That will have an impact. But who decides what impact that will have? So going back to my environmental heaven, environmental hell story before, in theory, those innovations, which had to be sort of piloted forwards initially, could have a huge positive impact. But on the other hand, they might just go spinning out of control and have the wrong impact. So my question isn't so much what can ESG do about that, it's much more about market design and what could market design do about that. And I actually think that's a possible PhD project. Perhaps needs a bit of framing.
It doesn't count yet. No. At the end, I want to hear a research question, testable hypothesis.
Okay.
No, I'm just kidding.
I've got one.
Okay, so we got two questions. Is there anyone else who would like to respond to this? Or we can go to the next one? Yeah. So we got Vicky and then Jane and then David.
Thank you. Vicky Cal from UBS. Perhaps starting with Professor Eccles, going back to your exclusions comment, how should we think about, or what part do companies, not investors, have to play in this debate? And then perhaps how should we as investors or practitioners be thinking about where companies can come into this from perhaps the other end?
So, as Rob has said in an email to me, engagement is hard, right? I mean, it's like you need sort of both sides. I mean, Judith will talk about this some. It takes two to tango. I think Al Gore has come out and he said, you know, we're not even going to try and engage with the oil and gas industry anymore. We think it's futile. And he's clearly thought a lot about it. And I think that that's a legitimate conclusion that people can come to. I think it probably turns out to be company by company and not necessarily sector by sector, because companies vary. I like the legal and general approach where they kind of give a company a couple of shots to improve, and then if they don't, they basically exclude them, they vote against the chair, they sell the stock. So I think probably a process like that, you know, sort of be clear if you engage what you think the objectives are that you want to see the company accomplish, you know, kind of hold them to task, you know, get metrics, you know, get reports, make sure they're valid. And if things are sort of moving in the right direction, then kind of continue to engage. And if they aren't, you know, then you can stop engaging, you can even exclude. One of the tricky bits, I think, about engagement is that in a sense, unless you're gigantic, you're creating a public good, right? So if you're an investor that's spending a lot of time engaging with a particular company, and, you know, you're getting these benefits, both financial performance or just impact performance, you know, whatever it is, you know, everybody else who owns that stock is going to get the benefit, but you've borne all the private costs. So I think another interesting study to do would be around, you know, kind of the public goods nature of engagement. I mean, there's groups like Hermes Equity Ownership Services. They've got a business model that basically supports doing it. When I talked to Michelle Edkins and a guy named Mark Wiseman at BlackRock, you know, I'm saying, well, you're doubling your staff. You know, it's a cost to BlackRock to go from 35 to 70 people. Mark says, well, you know, Larry thinks we might get another 1 or 2 bips. I'm not so sure. Well, you get 1 or 2 bips, you know, on $7 trillion, and it's probably the economics going to work out. If you don't, you know, then you're kind of falling back to the universal owner. You know, I need to do this to just make sure the world doesn't go into hell because I can't diversify away from climate change and income inequality. I mean, it's a complicated question.
Okay, Jane.
Thank you. Great panel, so many interesting elements. At BNP, we launched our global strategy a few months ago and committed to being a future maker, which is basically that we're universal owners, our clients are basically all universal owners, and if we don't achieve a low carbon inclusive economy, we will have, you know, kind of optimal economic performance and investment returns over the multi-decades that we're investing on behalf of our clients. So that's our commitment. We use divestment, we use engagement, we use ESG integration, we use all of that together to achieve that. I think one of the challenges when you ask people what they want is that often people think they want divestment, right? And if you look at the history of the divestment campaigns in South Africa, 350 today, you know, the focus on divestment. One of the really interesting papers, I think, from this conference that I read was around the positive impact that divestment campaigns within countries have in terms of reducing financing for new oil and gas reserves, right? So for me, I guess one of the really interesting things that we would love to see more research on is the multi-decade time horizon. So there's a lot of, you know, work looking at what's the optimization over a shorter time period and the link with material ESG factors. Of course, that's interesting for our investment professionals. But longer term, if we're all trying to move the ship to a lower carbon, more inclusive kind of path, you know, what tools from academia can we take as evidence to ask policymakers to, you know, one of the other great papers was around the mandatory disclosure of greenhouse gas emissions in the UK and the resulting reduction in absolute levels. So these are the kinds of policy engagement things that we want to be doing where we need more kind of academic evidence, I think, to help us. So one question is, you know, how can we get more focus on that? And then I guess just another reflection that I'd be interested in people's perceptions on is that there's a lot more focus on the E and the G in a lot of the academic research, and not so much discussion about equality and these rising inequality within countries. And I wonder if that's an area of focus for any of you.
Nick?
Yeah, no, I think definitely. I think building on the sort of divestment theme, I mean, I think one of the things that have been going around and people have been focusing on is actually obviously the contraction of the global oil and gas sector and its representation on the S&P from sort of 12% to about 4% now. So again, I think that's in a decade. So in another decade, as we think about how these instruments, which we should use as tools rather than constraints, benchmarks and so on, how are we going to be managing really quite disruptive change? Not on a sort of 3-month basis or a sell-side 1-year forecast, but as you say, on a decadal basis. And particularly, I suppose, sort of academic research and so on, which can identify some of the disruptive elements of it. I think there's still a view that this is going to be a relatively smooth transition, but I think some of us are knowing that there's this work that's been going on the inevitable policy response or abrupt shocks, particularly on climate change. How do we sort of think through these things from a strategic point of view? The social point, I think, is very strong, if I may just quickly on that. From the work I've been looking at, actually, some of the relationships between the social performance and returns and so on are actually much stronger than environmental, but actually haven't been looked at so much, particularly in terms of human capital formation, employee dialogue, and so on. And again, that was the point I was trying to make at the beginning, that often we do silo these work, and actually when we say sustainable finance, we mean climate, and actually it just needs to be much, much broader.
I'd just like to agree with what you said on the S. So last year I did a little project with the World Bank, and we interviewed 34 asset owners and asset managers all over the world, kind of big global names. And, they're kind of unstructured interviews and, kind of what are the system level things you're worried about. Everybody said climate change, everybody said income inequality. And they said, and actually income inequality is something we think is going to bite us harder and sooner. And we can see a path to investments that will help deal with the climate change issue. We don't see what the path is for investors to deal with the income inequality issue. But it was on the mind of everybody. It's a good point.
Good. Probably need also politics for that, but maybe it's not the right country to say that today. Okay, David.
Thanks, Rob. David Harris from London Stock Exchange Group and FTSE Russell. I guess we're seeing this huge momentum both in the markets and amongst regulators and policymakers on sustainable finance and investments. But is it underpinned by adequate academic rigor? And I guess linked with that, what's the right level of practitioner academic engagement that we should be looking to achieve?
I think you should ask the finance professor.
So you are from? Okay, FTSE Russell, okay. Yes, of course we should use academics, and we are doing it, but probably you're not aware of it. I told a little anecdote, it's not related to you, but to the UBS conference, that one of my PhDs, I gave him the assignment in 2010 to find the word corporate governance in the guidelines of the rating institutes, the regular rating institutes, Moody's, Fitch, and Standard & Poor's. And then he started digging. He started in the 90s when the word corporate governance emerged in practice. And he didn't find anything until 2005. Like 7 or 8 years after Enron, we got a whole bunch of governance problems in the beginning of the 2000s. So it's quite weird that the credit rating agencies were not looking at it. Yes, they need help. And it also holds for the index providers. The index providers are, in my view, now changing. I know examples of FTSE that they are now creating customized indices for clients at the client preference level. So that's maybe something that can help this discussion forward. Is there anything you would like to add? Because I saw that we have 4 more questions. We only have a quarter left, and you have to give me your PhD proposal. Okay, if I go to the next? Yes, so we are here. Just indicate who wants to ask a question.
Thanks so much. That's all really interesting. My name's Dan Nixon. I'm working with the Mindful Finance Institute. My background actually is with the Bank of England, 10 years in public sector policymaking. I'm interested in the ideas of culture and things like purpose, values, etc., and where you see the role for some of those slightly more nebulous concepts to fit in. I guess coming back to Professor Robin's idea of thinking ahead to 2029 and how we get to where we need to get to. There's been a lot on thinking around the concrete substance of how we get there. But I'm interested in the panelists' ideas on the role of culture or things like purpose or mindsets, if you like. Just quickly, my work is on human awareness or mindfulness and the potential for cultivating our innate capacities there to shift mindsets or to influence culture. That's obviously just one particular angle, but I'm interested in what are the ideas in that realm which speak to you guys.
So I think the board of directors of every listed company, and all the private ones too, should publish a statement of purpose. 1 or 2 pages, they can say whatever it is, builds on the work of John and Colin, but what's really important is it's got to come from the board of directors, because they represent the corporation, and they don't have to put shareholders first, which is the meme that everybody has. It's not a silver bullet, but I think once the board takes a public position, that sets up the basis for the conversation, and that can relate to culture change, but then you need metrics and discipline, blah, blah, blah.
And my favourite writer in this field is actually Donella H. Meadows, who wrote a primer on system thinking. And it's brilliant if you're not a system scientist, because you can still understand what systems thinking means when you read her book. It's fabulous, highly recommended. She talks about the importance of intrinsic responsibility. If the intrinsic responsibility of the system, so let's say it's a corporation, is to deliver returns to shareholders, that's what you'll get. So don't be surprised if other things don't happen. If the purpose of the organisation is to look after the environment and to operate in such a way that you are always aware of that environment, then that's what you'll get. So I think you're absolutely right. And Bob, you know, it ties into yours. I think purpose is absolutely critical. You also ask a great question about culture. I think that's enormously important. And the fact that it's intangible and often can't be measured doesn't mean that it doesn't matter.
We've got a paper coming out in our 4th quarter edition where, it's not quite as deep as that, but re-looking at some governance metrics in a way to make them more material, I guess. And he looks at 3 potential sources of variation in governance metrics across the world. I don't think I'm going to remember them all, but the one was legal tradition, saying that countries have different legal traditions and that influences the way they engage and the way they respond to law and legislation, etc., and make new legislation. And the other is what he called shareholder inclination, which he was also a market-related thing, talking about how different countries have a different sense of rule of law, the extent to which the country is likely to advocate for a breaking of the law, etc., and that changes the way the shareholders are. So again, not as deep as culture, but it's in there in the governance metrics.
Nick?
I think it obviously means we need to think about the whole person in our whether it's our modelling or behaviour, and particularly take account of the work that Rob Lake has been doing about the authentic investor. I think sort of looking at the whole investor.
So believe it or not, the Journal of Financial Economics in 2015, so these papers were written in 2010 or so, and it's a conservative finance journal, had a special issue on culture and finance. So I would definitely read that as well. And it actually shows, coming back to you, that if the CEO doesn't live up to the promises made by the board, then the company has a problem. That is one of the results in that papers. Okay, who was here? Was it you? Yeah.
I'm Maxine Nelson from the Global Association of Risk Professionals. Our best known product is a master's level certification in financial risk management for finance professionals. And they need more education in sustainable finance and the potential impacts of climate risk and sustainability. How do you think we can better or faster transfer knowledge from academia to practitioners? Because I think that transfer of knowledge is a bit slow at the moment.
Well, that's something that falls very much in my job brief, actually. Not all of academia to all of practitioners, but certainly a very important thing of what we do is we have this academic journal, but it's a very important thing to be able to transmit the value of that journal to the membership as well. And we have another product that summarizes academic journals. We go out and scour academic journals, try and filter out what's in there for practitioners and to distribute that as well. So I think having some kind of body or access to professionals is the starting point. Believing in continuing education and perhaps even mandating continuing education is a possible way to go. But then backing it up with material that is practitioner friendly. In a broader journal world, beyond finance, people are doing all sorts of interesting things in order to bring research to the communities which they actually serve. So there's a difference between cancer research versus cancer research that patients can read. And they're doing all sorts of innovative stuff that I think we can borrow from, everything from graphic novels to cartoons of the abstract.
Yes, I'm visually oriented. You hear them. Okay, go ahead.
Yeah, I mean, it's maybe responding to David's point as well, is also, I think, actually, academia could benefit for actually better understanding practice. And I think that would be in terms of what do real risk managers do and so on. I think there's a sense that all the wisdom, certainly my experience has been that we have practice which is way ahead of theory.
I think you need the academic finance community is the gating factor. I mean, you're a rare exception. You could probably count on two hands the number of finance faculty around the world that think there's any meaning to this stuff at all. They all think it's bullshit, right? You know, they've got their theories, and they've got their models, and they've got the journals they publish in, and they think it's rubbish. So, you know, you need to kind of do a Vulcan mind meld in the academic finance community somehow.
And just to say, we're hungry for ideas. So, yeah, we're very open to anything. Good communication from academic institutions.
But we still need financing. So I come back to you on that then. Dirk.
Thank you, Dirk Schoenmaker from Erasmus University. Bob, you raised the issue as where is private equity? And we talk a lot about investors. There is another party to the game, investment banking. If you go to the world of real companies, with M&A, we reorganize companies to better performance. And sustainability is not at all in this analysis of M&A. So how can we get investment banking interested in this issue? And should we get them interested when they do their M&A analysis?
So, I mean, you're from an investment bank, so I'll take a quick whack at it, then you can give like the knowledgeable answer. You know, I think part of what's driving that is it's just kind of a lack of knowledge, right? So they have to do it and they incorporate it into due diligence. I mean, the private equity firms are doing it more. But I also think a lot of it is with the bankers, not the analysts. They just want to get the deal done, right?
And I sit in equity research, so obviously I can't talk about bankers because they're on the other side of a Chinese wall. But I can say that Jeff Robinson, who heads up our valuation and accounting area and is our sort of modelling guru, has gone into print basically saying that, dear analysts, when you're modelling M&A situations, if you fail to take into account the different cultures of the two organisations you're looking at, your model will be rubbish. So in equity research, we certainly do have that kind of education, and I obviously can't talk to the other side of the Chinese wall.
Okay. Well, we have room for one more question, and then you can come up with your research ideas. That's at the back. Go ahead.
Hi, everyone. I'm Julian, University of Zurich. Great to be here. Bob, you were mentioning that inequality and climate change are kind of the biggest issues that were raised in this panel. And I would agree that the ambition should be to solve these issues. But I also think that investors and financial markets play a part in a sort of much bigger picture, of course. So my question is, what is the thinking around collaborating with other important stakeholders in order to strategically get there? So one thing I heard recently, someone argue that ESG data should be for free, so that those that use it don't start with an initial cost disadvantage. And other things in this direction, I'd be interested to hear. Thank you.
Okay, Nick?
Well, I mean, one obvious one is financial policymakers and regulators. There's a lot of work being done there, central banks and so on, whether it's securities regulators, banking regulators and so on, but also sort of financial market design, notably in the EU, very comprehensive Sustainable Financial Action Plan. And as many of us will know, one of the key things they are promoting is a sustainable finance taxonomy, which has a lot of supporters. I think it's strategically very, very important. But I think that will help us get a common language and a common classification system for some of the things we talk about. I think we talk still in very, very loose terms about some of the things we're talking about, green assets, brown assets. I'm going to need a lot more sort of specification and clarity, and that's where research can work very closely with financial policymakers to ensure that those market standards are accurate and helpful.
Julie?
And obviously data is never free because there's a cost to collecting it. So the question is, if ESG data is to be free, who pays? But then you can think about data in a different way. So in equity research at UBS, we will look absolutely anywhere for good ideas, as long as the data helps us to address an investment question. And we have collaborated with other parties, and there are some fabulous pieces of commons data out there in things like water stress, air pollution, and so on. And so I think, I guess when people talk about ESG data, they think it's the kind of data that's disclosed by corporates. Well, if you're a very large corporate and you happen to have really huge resources and publishing the ESG data is done at marginal cost, well, that's great. You might not mind too much about it being out there in the public domain for free, but if you're a smaller organisation, that could be a disaster and you would need some sort of subsidy. So I'd suggest there is data already out there which is a commons which can be used in the field of analysis, ESG analysis or just analysis, but it isn't an easy matter to make all data free. So maybe we do need a different model.
And even if it was free, right, ESG data is not well defined, financial data is well defined. In your paper, to give a shout out to your paper that you did with Florian and Roberto, Aggregate Confusion, I mean, if you haven't seen this paper, you should get it. I mean, it's this brilliant study. It kind of unpacks why there's differences.
What's it called?
It's called Aggregate Confusion.
Aggregate Confusion.
The divergence of, ESG ratings. I think is the full title. Fabulous paper.
Got it.
And it kind of unpacks, why you've got this lack of correlation between MSCI and Sustainalytics and all the rest of them. I forget which one is exactly used. There is an organization, though, that's trying to do, Julian, what you're talking about, called the World Benchmarking Alliance.
Oh, yes.
Where they're going to benchmark 2,000 companies for the 7 systems they say are important for the SDGs, and make this data publicly available and kind of use that. And they'll rank the companies from, the best to the worst, and obviously trying to use that to change the behavior in the companies that are ranked the worst.
I know that somebody wants to respond to the question in the audience because we don't have time for a new question. No? Then you don't want? Okay. We are at the end, and the end is going to be really done by you. So I saw you making a lot of notes, Julie, so you probably have a good research idea, don't you?
She has a PhD.
You have a PhD?
She has a PhD.
I'm
You're not
writing.
allowed to answer.
Not in finance.
I'm not allowed to. Well, no, okay, so I'll tell you
You
what
also
my...
have a PhD.
So I'll tell-
Who doesn't have a PhD here?
I'll tell you what my PhD question was, right?
Okay, that's
The environment on stage, is it scenery or shapeshifter? That might sound like a completely literary kind of question, but of course, as I did my PhD, I discovered it's exactly the same question that I'm looking at every day in my work as a financial analyst. So in other words, is the environment somebody just thinks of as out there, at the margin, or is it integral to everything we do? And of course, it's integral to everything we do. And the bottom line to I'll just quote one thing. When I see a bicycle drive the logic of any theatrical production, I have hope for the human race and the environment.
Heidi or Nick or Bob, you already gave us 3 ideas at the beginning, isn't it?
I've just got one thing on the education question. I think education on risk and returns and ESG needs to start with fiduciaries of the funds. I mean, that's a lot of the work that you do. I mean, in the United States, there's still this ideology. It's, oh my God, it's like transfer payments, philanthropy. You got to change that.
Heidi?
Research question, or certainly the kind of research I'd like to see more of is research that puts everything into heterogeneous context. So certainly with ESG research, I'd like to see more dealing with the differences between what ESG looks like in China versus what it looks like in an emerging market that's small versus what it looks like in a market that's big and well developed, because we can't simply just sweep over these markets as if they're one thing anymore. And I'm also getting sick of reading only developed market research, to be completely honest. We certainly can't address inequality if we're never going to talk about the smaller or the poorer. So I'd just like to see more context in financial research as a whole. But a further challenge too, please. I would like to see universities respond to the social impact question as well, in the sense that I would like to see universities account, like a company would, for the impact that their research and teaching is having. So I know many do already, but I'd like to hear from people who are getting promotions at universities or from universities as a whole. How has your research impacted practice? How has it impacted legislation? How did you manage to get the findings of your research out into the world where end users, people who are actually investing rather than investing professionals, can actually read it and understand and create demand through your research?
Nick, the last
So
word for
I'm
you.
very greedy, I'm afraid. I got 3 PhDs and probably 7 of each. So I think it's very good to hear the question about fixed income. Debt is the biggest asset class. Banks are the biggest part of the financial system. And this is an area for joint research. The data on banks and their loan books is never going to be public. The central banks hold it. So some very interesting joint PhD research potential with central banks and universities to understand implications of sustainability factors. That's one. There are 40 member banks in the NGFS, so there are lots of PSG opportunities there. Second is place-based research to understand actually what can finance do to link climate and inequality in the high industrial zones of the world, whether that's in China, or whether that's in Europe, whether that's the US, and so on. What can finance do to ensure we have a just transition? And then my particular passion would be on India. Lots of work in many, many countries. Something happening in India, a little bit in the debt markets, a little bit in infrastructure, but a lot of PhDs. What do we need to do to promote sustainable finance in the particular context of the Indian financial system?
Okay. Well, thank you, panel. You had a really lively contribution. I think we also got great questions from the audience. So I'm very hopeful that this after party will be filled with people, if that is a prediction. So I would really, all of you, like to thank the panel for all the time they took to do this.